Welcome to the Investor's Playbook, your voice in Scottsdale and Paradise Valley luxury real estate. Whether you're a seasoned investor or new to the game, consider this your edge. And now, your host, Frank DiMaggio. It's time!
Thanks for joining us on a very special episode of the Investor's Playbook. Tonight I have two incredible guests. To my right, Waseem Hamadeh, and to my left, Nico Howard, the founders of Silverback Capital. And we're going to be asking them questions about being an investor, being a lender, and everything they've learned here in the Phoenix, Paradise Valley, and Scottsdale markets. So Waseem, I know that you've had a lot of experience in the residential market. A lot of our listeners are here to learn about investing and here to learn about investing in residential flips, new builds, dirt, everything that you do. First question, what do you think is the most important thing for kind of a first-time investor in the Scottsdale Paradise Valley market to know if they're going to try to dip their foot into this field?
So I would say, very importantly, is take a long-term approach. Anything that anybody does should always look at planting seeds today to harvest in the future. So it's 3 years, 5 years, 10 years out, and then know the market really, really well. I had one individual years back call me saying he was having an inheritance and he just wanted to buy something. Biggest mistake you can make. So for years before you buy anything, you should be understanding the market, understand values, understand what sells, what doesn't sell, know it better than anybody else before making an investment decision.
And Nico, I know that you've had a vast amount of investment experience and obviously lending experience, but I want to talk to you a little bit more about the lending side. So when you're looking at deals and when you're underwriting deals, obviously you're seeing 100 deals and you're picking those few that you think make a lot of sense. When you're going through that thought process, what are you looking at to decide which deals to actually fund and which deals aren't going to work for you?
Yeah, first of all, Frank, thanks so much for having us. Great to be here. It's a good question, and I will neglect the fact that you actually gave the first question to Waseem. I'll just overlook that entirely and answer the question that you asked. I think just 2 words, I'm always looking at the worst case, right? The worst case scenario, I think that there's a tendency that people have to be overly optimistic. They're looking at, if this happens and this happens and this happens, I'm going to make a lot of money. But it is assumed and not proven that any of those things will happen. And we never take those for a given. So first of all, if there's a lot of contingencies in a deal where 3 or 4 things have to go right, interest rates have to come down, net in-migration has to continue, Trump doesn't tweet anything crazy that week. If all those things have to happen for you to make money, I would suggest you shouldn't do that deal. I'm looking at factors that exist today in the current economic climate with the current conditions as we see them going flat or even declining a little bit. If those things happen, do I still make money? And if the worst case scenario comes to fruition, how much money do I lose? Is my capital impaired? I'm a little bit more risk averse than most. I think Waseem would be the first to tell you I sometimes have to be talked into doing any deal. But if you're going to lose a lot of money, I just stay away from those deals. I just don't believe in that kind of risk. And so I am looking for true asymmetrical return profiles. Will this make a lot of money if things go poorly? And will my capital will I make a lot of money if things go well? And will my capital be safe if things go very poorly?
Yeah, I think what you're kind of saying is you underwrite to the downside. And I think as an investor, I had a conversation today. It's ironic that you said that, where somebody was pitching me a deal and they were telling me, hey, look at this house over here. Look how well it did. This lot's not as good, but if you can do even close to what this deal did, you'll do really well buying the dirt here, building it there. And the conversation I had with them was, look, that was at a time when the market was peaking. And I think somebody potentially overpaid for that deal. Now all of a sudden you want me to underwrite as if that's the standard when it's not really the standard, it's the exception. And I'd rather underwrite the deal to the downside and say, hey, let's look at these 3 other deals that didn't do as well. And let's underwrite looking at those as the comps and not this hero deal that came out once every 5 or 10 years.
Yeah, and Waseem really struggles with this part, but you always want to buy it lower than where you sell it.
Yeah, so
you're looking for a gap there. Yeah,
that's great advice. So, with your experience specifically in Paradise Valley, having done flips, what's some of the most important things that you've learned in the flip game in Paradise Valley and Scottsdale that some of our viewers could gain knowledge from you?
So it changes over time. So I would say the market is always adjusted. So when I first got into it is 2016, 15 in PV. I was doing it for a decade before 2015, but in 15, 16 is when I entered PV. Paradise Valley at that time was not getting premiums for light fixtures, for any kind of the quality of the work or the materials. So you can spend 3, 4, 10 times the material cost on something. No one's giving you a premium. So you had to work within those constraints at that time. Now, quality assets, quality materials, quality building is getting you a premium. And if you don't go with quality in that marketplace, and everyone talks about the K-shape. Nico and I just got back from Manhattan, and every economist talks about the K-shape recovery and the difference in socioeconomic. The wealthy are still spending. They still have capital, and they're spending it on quality. And if you cheap out or you try to cut corners or not get the best product for what you're trying to sell, the best products and materials, you're gonna take a big hit. And you see it. That's when you see properties that are sitting in the market for 8 months to ones that sell within a month. And that's the difference now in this market. What I've learned was that the question?
Yeah, like, what are some of the things you've learned through the process? I mean, you've been doing this for almost a decade, and I'm sure that there's times where you thought, hey, this deal was going to be a home run, then it didn't work out as well. Then there's probably other times where you thought, oh, this might just be kind of a single or a double, and then it ends up being a home run. And through that iteration, you've had to have learned some things.
So I would say how you buy it is one of the most important things, right? Execution is very, very important, but the way you buy it, your entry price going in is very important. Second, I've been doing it for two decades now. So for over 20 years, my first renovation was in 2006. Know the dollars, pay attention to the dollars, pay attention to the pennies, know your costs. I always have a lot of respect for guys that are flipping a $300,000 house or a $10 million house. A lot of it, there is some characteristics to it. They should know what the hinge costs. They should know what the hardware costs, a door handle, tile, flooring. There are guys out there now that are partnering up with other people. They're bringing in capital, or they're trying to bring in capital, and one of the partners runs everything. You're not getting any education lesson in that case. So if your partner is out there buying and watching the costs, you're getting left behind. So you need to know the material costs and know what it should be, and plus or minus what subs should be charging. You need to know that side really, really well, and be adaptive to the market, because the market conditions change all the time. Nico said it well. Just always make sure you're protecting your downside, and the upside takes care of itself.
Yeah, I totally agree with you when you talk about especially the luxury market, which is mostly what we talk about on this podcast, because we talk about Scottsdale, Paradise Valley. So it's almost all luxury. Your buyers are so educated that they can easily disseminate between who's cheaping out on a remodel and who's going the full boat, who's doing every aspect of it, who's really doing that gut remodel and giving them what feels like a new house. And I agree with you. I think those are the houses that sell quickly and sell at the premium, and the ones that are trying to put lipstick on a pig struggle, and especially ones who don't do the whole way. They're not remodeling the entire house. And
they know the brands, right? That clientele, even if they're not in the business, they're going to know the brands more than the investor that's trying to get into the business. Like, they're going to know when someone went cheap or when someone spent money on something. They can tell immediately because they've been around it. That's their world. It took them a while to get to the point where they're paying a $10 million for a house. They went through all the steps to get there. So they've been exposed to it.
Yeah. So Nico, I know you know real estate. I know you know land, but I know that you're definitely a land guy. Like, you definitely know land probably as good, if not better, than anybody in the Valley. So talk to us. If you've got somebody out there who's interested in getting into investing in land, what would be some of the things that you have learned through your process? Have you had any pitfalls? Have you made any mistakes that you've really learned from? And kind of what's that lane that you think has the most upside right now?
Yeah, I would tell you, I'll give you kind of a couple answers. The first is really how to cut your learning curve in half. And I only know this because I went through the pitfalls and I didn't do things in the way that I'm recommending, and I could have done things a lot faster. If I were to do it all over again, I focused really heavily on entitlements. I think that's time really well spent, but I did not focus as heavily on engineering. So really understanding utilities, infrastructure solutions, how sewer systems work, how it sounds crazy, but the mechanics of wells. And you don't have to be an expert in these things, but just knowing, if you have a piece of land, how is that going to get served when you turn that faucet on and water comes out? How does that happen? If you're dealing with municipalities, where are they getting their water, right? An issue that we've seen really prominently in the last couple of years is certificates of assured water supply. How does the state actually regulate water? What is the ecosystem in which we exist between other states? Where are we getting our water from? You see the CAP canal and you hear all this stuff about that. Are we running out of water, ag to urban? So that's the first thing I'd say is understand water, understand sewer, understand right-of-ways, Really go deep into those issues. And the best way to do that is to either pay or to make friends with a civil engineer and just sit with them for, if they're willing to do it for 1 hour a week for 5 or 6 weeks and learn the basics of civil engineering. Another one that I put in that is grading and drainage, slope, all these various things and how they impact costs. And as you get to know these things better, you can also get into value engineering where you can really cut costs out of a project to say, let's do it a different way. So those are two big ones, entitlements and engineering. The other thing that I would say about land is just knowing at the outset the characteristics that really define that asset class. It is an illiquid asset class. If you think that you're going to get in it and out of it quickly, you are wrong. It will always take longer than you expect, and there will always be pitfalls along the way. With land, the benefit of an illiquid asset class is you really only have to be right twice in a market cycle or twice in a decade, the day that you buy it and the day that you sell it. But you need to understand there might be years and even decades separating those two events. And so that's what I tell people that are getting into land is you really have to be super high conviction when you make that purchase, because a mistake in land will take you a decade to extricate yourself from. And so people that do it haphazardly always get hurt.
Waseem, I'm going to ask you a real specific question this time, which is, in your career, has there been any one mistake that you've learned the most from? What was it, and what did you learn?
I mean, I think I've been very blessed and lucky, probably compared to many, that I've had really good people around me in my life. So it's tough to just...
He's talking about me, by the way.
That's Nico.
Yeah.
I've been very lucky to have Nico in my life.
He keeps you out of the bad deals. Isn't that what I hear? That's all I hear.
I keep him out of the good ones, too.
Yeah, exactly. Yeah, I'd be so much bigger if I didn't listen. So there's a lot of truth to that, though. Nico's been a blessing in my life. There's been a lot of other people. Greg Vogel has been incredible in my life. Wayne Howard has been incredible. Mark Stapp. I can go on and on. But the reason I say that is when you're sitting in the room with these people, they tell you the war stories. It's the war stories where you learn the most. It's not people's successes, because when successes happen, you just start trying to repeat it and you kind of find other successes. It's the war stories, it's the pitfalls, it's everything Nico mentioned on the land side. That translates to every other asset class. So even land, like 404 washes, you need governmental approvals if you buy a big piece of dirt, and a lot of people don't even know that. So are you relying on cities? Are you relying on federal government to get your project across the finish line? That can be a 3-year delay, 4-year delay, depending on what it is. Nico and I purchased property in California, and there's a bridge. So you gotta go through the federal government to get approvals on a bridge. That happens in every asset class. So even if you're doing a flip or a remodel, I can't point to one thing and I would say, hey, this was a big mistake. I think underwriting the proper way, it becomes one of the more important factors. And then being around a lot of really successful people that are operating at a high level and that share their stories, that share all the war stories. You want people that talk about the negatives. They talk about the failures. They talk about what you should be aware of. Those are the lessons that you don't necessarily need to repeat yourself. You'll absorb it, and it'll help you make a decision for the next investment that comes up.
Yeah, and I would kind of liken that to like sports. If you want to be a great baseball player, yeah, you have to practice when you're on the field for sure. When you get home, you watch other people play. You watch baseball games. You look at people who did it well. You look at people that screwed up. You have to be breathing this stuff all the time to really be good at it. And I just, one of the things that we do in our office is deals that we didn't invest in, deals that we passed on. We always follow those deals for the next couple of years to see how the other guy did. If it was a deal that we would have made money on that we didn't do, if it's a deal that they didn't do well on, we always just want to know, was our thesis correct? And not even just is it correct, but was it the optimal deployment of capital? Let's say that they made money. Could we have made more money elsewhere, or should we have done that deal?
100%. And we do that on even Zillow, right? If someone has access to MLS, that's good. If not, you can even do it on Zillow. You'll see properties that you've been watching. That's why you have to learn, just watch the market really well and just watch it deep every day. Just kind of play with it online when you're sitting at home. And you'll see it sell, and then you'll see it 6 months to a year and a half, 2 years sell again, or come on the market for sale. You'll see that they did work. Properties start becoming, they start being recognizable, and you can kind of gauge, hey, they put this much into it, they're selling it for this, they're going to take a loss on that property. And we do that all the time. We do that on land deals, commercial deals. I've done it on deals from the 1980s, on different market cycles, on large lands transactions and what the pricing is done per acre. And then, yeah, we watch the deals that we pass up on, and Nico's absolutely right. And sometimes people do make a profit, but it's a small profit when they could have rotated their capital, and velocity of capital becomes more important than trying to eke out every dollar in a deal.
Yeah, and I would add to that. When I was a beginning investor, I had a lot of FOMO. If there was a deal that we could have done that we didn't do, and that next guy tripled his money, I would think, shit, that should have been us. We should have done that deal. Today, as a little bit more seasoned investor, nothing makes me happier than seeing someone else successful and seeing somebody else make money. And I would rather pass on 10 really profitable deals than do one that has a high risk of loss, because there is always another deal coming behind it. When you're just getting into this game, you have this erroneous belief, this scarcity mentality that like there's a finite number of good deals out there. Every year there's going to be 10,000 new good deals in the economy, maybe more than that. And every time there's a change in economic conditions, every time there's any kind of volatility or net in-migration patterns change or whatever it is, there's going to be the creation of new deals. And so never get hungry, never stretch, never try to make something work. Like if you have to make effort to make something pencil, I've got bad news. It doesn't pencil.
It's not gonna work.
There's nothing you can do to change the economic landscape to make that a profitable deal if the back of the napkin math doesn't work. And so you'll see guys talk themselves into deals all the time that they really should have passed on. And the reason why is because they don't have good pipeline, right? They don't have good deal generation. And so they're focusing on trying to make something work because they have a finite number of deals that they see, when in reality they should be investing in relationships to help them build that pipeline so they can go look at and underwrite another 50 or 100 deals. And so it's just a misallocation in my opinion.
For sure.
I asked that question because I had an ulterior motive, because I have a story of a time where I made a really poor deal where I had to pay a guy pretty much $200,000 to move into the house. And I'll never forget it. I'm glad it happened early in my career because it taught me a great lesson, which was, I was concentrating on Paradise Valley and Scottsdale. Every time I made an investment, I knew every street, every deal, every off-market deal, things that were coming, why certain houses sold for certain amounts and why other ones were dogs, and just every aspect of everything. And then all of a sudden, a deal came up in an area that I wasn't working. It was a nice area. It was a great area. Everybody knew it as like, oh, that's a great part of town. But I didn't know it. I didn't know it well. I knew it was a nice part of town, but that was as much as I knew about it. But it was one of those things that I thought, I'm doing so well. I've done so many deals. I'll make it work. Like the house will turn out great. And it didn't. The house turned out great, and I didn't know what I should be charging there and why certain houses around it had sold for big price per square foot and why mine didn't, because it was a different type of product. And I'm actually really happy it happened, because it was probably the best education I ever had, was having that one deal go south on me, where I got to feel the pain and I got to see what happens when you step out of your area of expertise, and how the market will kind of slap you down.
For sure. And it's such an interesting thing, right? Like if you look at the relationship, it's really hard to do a good deal, and it's really easy to do a bad one. And so I just remind people that all the time is like, most of what you see is going to be bad. Say no more than you say yes.
So, obviously a lot of people who watch the podcast are investors, or they're looking to buy a house or sell a house in Paradise Valley. So where are you seeing the market, in the 26 and beyond, as far as Paradise Valley and Scottsdale?
So I think there's always going to be opportunity out there. Kind of to Nico's point, the pipeline's always there. You have to keep your ear on the ground. Guys like you, Frank, you're out there all the time. You see many, many opportunities all the time, and you're able to give them to clients. You work on them yourself, and you have an abundant mentality, right? And you share everything you see. I think you just got to be surrounding yourself with people like that, for anyone that's listening, because we're not all going to see all the deals, right? I don't think you're going to have an environment where there is a mass deal flow in anything significant. I think it's going to be just quiet, similar to what we've seen in 25 and 24, where there will be transactions out there that make sense. There'll be deals out there that make sense, but it's going to be hard if someone is relying on a volume-based business to do a whole bunch of deals to find anything good. So I think they just have to keep the relationships and open communication going with everyone out there, and just let people know that they're looking to acquire and have capital lined up so they can move quickly. I think that's a key. And then just here and there, something will come up. I think it's difficult to find anything right now where there's any kind of distress or any opportunity of significance. But one-off situations are occurring in every environment.
Yeah. So in your eyes, in 26, you're not going to see tremendous growth. You don't anticipate kind of anything pulling back. You're just kind of seeing the consistency of what we saw in 25.
I think so. And what I've said for years is it becomes more operational heavy. Like it becomes now where before in 2021, if you acquired something and you got out of it fairly quickly, you did well because of market conditions and factors outside of someone's control. Now, I think, and especially moving forward, I think everything's become more institutionalized. Arizona was a sleeper state, and that's become more institutionalized with more money in it, more institutional capital in it, and then more investors that are just high net worth guys that are getting into space or partnering with other guys that are in the business. There's more money chasing fewer deals. So I think it becomes much more important to execute properly, to be operationally lean, understand the execution side of it. So if someone knows how to perform, they're going to do well. But there's not going to be deals where they can just buy anything and it's going to resell at a good number. I think they're going to have an exit for it and work through that property.
One of the things that I like to talk about as a real estate agent, as an investor, when I'm talking to whether somebody wants to buy or sell a house with me or somebody's considering funding one of my deals, is how I try to differentiate myself from everyone else by conversations like these, conversations with people like Waseem and yourself. And one of the things that I've always taken from you that I want to get your take on is you're one of the few guys, I think, in the market who look at the micro and the macro of so many different aspects of when you invest and why you invest. I think sometimes when I talk to Waseem, he'll talk to me about a deal. He'll be like, hey, I know this deal on this one street in Paradise Valley. What do you think about it? I've been looking at it. And the conversations I have with you, I think, are about those micro things, but there's a lot of the macro about what's going on. So based on the micro and the macro of what you're seeing, what do you think 26 and beyond looks like?
I'm also not as smart as Nico, so
Well,
he gives you a lot more perspective.
I didn't think you even had to say that.
That's what you were saying.
He's a lawyer, right?
Let me return the shout out. By the way, the last guy you want on your deals is a lawyer, right? If you want a deal to die, put a lawyer on it. Let me just return a quick shout out because actually Waseem has been one of the greatest teachers that I've had in my business and in my career, and I've learned such an incredible amount from watching him, from working with him, from the conversations that we have, both as business partners and as friends. So I just want to return that shout out. Look, I don't have a crystal ball. Nobody does. I think you can look at all these macroeconomic indicators, and they point to a pretty good year for the state of Arizona, in my opinion, in 2026 and beyond. I think that we're very insulated. I think that there are other markets that had similar run-ups in valuation over the last couple of years that were driven by changes in demographics. People vote with their feet. We have that expression. In the pandemic, people moved, right? And so there was growth that took place very quickly. To Waseem's point, I think that Phoenix as a market was very undervalued. I'm just going to say that again. If you look at the demographics, I think that Phoenix as a market was very undervalued for a long time, right? And so there was some embedded growth in there that needed to catch up. I think that that's happened. I think that we've caught up. I actually can't believe that we're valued at the level that we are. You look at certain places in California, and Paradise Valley is as or more expensive, which, having grown up here my whole life, I can't believe. I mean, it's hard for me to wrap my head around that stuff. But you have an incredible job story. You have TSMC that's come to the Arizona market. You have a ton of federal money behind it, which that's a really important point that I want to harp on for a minute. That is not quote unquote market fundamentals. That is not supply and demand. That is federal money that is going into the ground no matter what. That has to be spent. If the stock market crashes, that money is still going to be spent. And it is being spent under the label, and this is probably valid, but of national security, of defense. I mean, it's not about an economic agenda. It is literally about our reliance on foreign chips. And so that cannot be stated heavily enough. You have TSMC, you have, I guess, Core Power now went away, but you have LG, you have Intel, you have these major employers, and all of them have co-locators that need to be in this state with them. You have Amcor that's going in. These are major things that we have in our state that others don't. So you look at like a Texas, you look at a Florida, you saw major run-ups in growth in those places. You're seeing a contraction in those places now that we're not seeing in Phoenix on the same level. So I think that fact is really important. I think the consumer is still very healthy. We spent a lot of time with some of the bigger managers in New York, and that was one of the points that they kind of kept coming to. Savings are high. Debt is actually high, but as a percentage of income, it's below the 10-year trend line. I think people are healthy. I think people's homes are worth a lot. I think you have people that have access to capital that they may not have. There is, in fact, a huge wealth effect. A lot of people are invested in the stock market. They feel very rich right now. That allows them to continue spending without concern because they see their bank statements going up. If you see a correction in that, I do think you see a pullback in spending. I think that a lot of the spending and consumption that's taking place in the economy, and mind you, 70% of our economy is consumption, right? So if people stop spending, that radically changes everything that we see. But that spending is really being driven by high income earners, right? That is not being driven by the guy that's taking your order at Arby's. That is being driven by the lawyers, the doctors, the accountants. So any disruption in that market segment, I do think that you will feel it. I've kind of rambled on for a while. Is this what you're asking for?
It's perfect. I mean, it's one of those things like, when we're doing the podcast and we field questions and all that, I think to myself, like, what are these most common questions that I'm getting? And one of the most common questions, no matter who I'm talking to, whether it's somebody that's looking to invest in Paradise Valley or Scottsdale, or it's somebody that's buying or selling their house, their first question typically out of their mouth is, how do you think the market's going to do over the next 6 to 12 months? And I kind of give a similar answer to what you said about, hey, nobody's got a crystal ball.
Yeah.
But when I look at Seattle, Portland, all of California, for somebody like myself, that is a new market segment that's come in at such a bigger rate than ever before. We've always been, the Midwest and Canada have always gotten to the point that if they've made enough money and it's time that they wanted to retire somewhere with money, they were coming to Arizona typically. If you were in the Northeast, you were going to Florida.
Yeah.
So that trend of those consumers moving here has been pretty consistent. Then all of a sudden, COVID hits, things change on a macro level, and then 3 major locations with a lot of high earners all of a sudden starts moving to Arizona. And they're coming with considerably more capital than what we're seeing out of the Northwest and even out of Canada. And they're willing to continue to bid up the price to get what they want when they want it.
Yeah.
One of the other things that I talk about with a lot of people is the baby boomers are getting to a point where they're at an age that they're looking at the calendar and they're looking at their bank account and they're thinking to themselves, I got enough here. I don't have enough here. And they're starting to make decisions differently. They're coming into the marketplace and they're like, this is what we want. That's what I want. It's ready to go. What do we need to do to put the deal together? They're not wanting to hammer down on every last $25,000, $50,000 because if there's somebody else who's in the same boat and they're willing to fire higher, they're going to have more FOMO about losing the house than they are about saving the 25 or 50 grand. And I think that has changed as that baby boomer generation is getting more into their 70s.
Well, I think you hit on something that's really important, which is that the socioeconomics of this demographic has shifted entirely, right? And so you used to see price sensitivity, not necessarily of a reflection of the value that people saw in the homes, but they would just say, hey, look, I'd love to go higher. I can't, right? We've kind of reached my limit. For the first time ever, I think that you're seeing real coastal wealth come into the Arizona market. And that started, a couple of years ago. But it is, mind-boggling some of the wealth that is actually coming here. Seeing people that sold, $250 million company in San Francisco or Portland or New York or Chicago, and they are coming here with a very different eye, and they're looking at this real estate. I'm speaking strictly in luxury residential right now, but they're looking at a high price tag and they're saying that's actually cheap. So I don't necessarily underwrite a tremendous amount of growth the way that we saw the last couple of years. Again, I think that some of that was catch up, but I do think that you're seeing an inflow of people that our market has never had before. They just have different tastes, have different preferences, a different level of demand where it used to be you would never build a $20 million house on spec because there were only 7 people in the state that could or would buy it. The number of buyers for that product has gone up exponentially in the last couple of years. So for your business, I think that's a really good thing. But I'll tell you, for me, I'm a value investor through and through. That still confuses me.
Yeah, and I would also say when you're looking at economic conditions and you try to forecast, The issue with forecasting is we'll always be wrong, right? All of us are always going to be wrong. You can't predict government intervention, right? The TARP money out of the great financial crisis or the crash, the money that came in post-COVID, both administrations threw a whole bunch of money in there that helped move everything up. 2018 and 19, all of us internally in our office, we were saying everything's overvalued. Everything's too expensive in 19. And how many friends that we all have that said, oh, I can't buy something in 19. I'm just going to wait till the market slows down. I'm going to wait till prices go down. COVID hits, you think everything's going to crash. I had a lot of rental properties. I was worried about tenants paying the rent. But
that was the correction. That was the correction.
And then I was in the luxury space. So like no one missed a payment. They're paying $10,000, $15,000 a month. None of my tenants missed the payment. And then government intervention kicked in and we had so much money infused in the system, employment, population growth, everything we talked about. And now prices are double what they were in 2019 and interest rates are double what they were. So you got double whammied and you're out of the market. So when you're talking about investors that are looking to enter the market, you're never going to predict the future as long as they stick to what we're all talking about is the fundamentals and buying right and buying in good locations, strong locations, well-located properties, and you have staying power. If you have a high interest rate loan and it's due in 6 months and you need to get out in 6 months, you're going to get yourself in trouble. If you have staying power, you have the money, you can fund stuff, and if things go bad, you can just rent it out, hold it. It will always recover. As long as you're buying good quality assets and you have staying power for it, you're going to be fine. But you got to always stay in the game. To your point on losses, I've taken losses on a few properties, and that's fine as long as you have much more winners than you have losers, and you limit the losers, right? You limit the downside, and the winners you're going to have some of them that hit home runs. To Nico's point on the businesses that are moving here, when I was at Land Advisors, we would try to sell these large land holdings, and we'd have all these institutional guys come out of New York, and they're looking to place capital here. We were always the secondary market. It was LA, it was Texas, it was New York, Florida, certain areas of Florida, but like we were always secondary, maybe tertiary. Now we're a primary market because California has a very difficult political environment, has rolling blackouts, has fires. Texas has floods, has same thing with rolling blackouts. If a company has 1 day of disruption on the electrical grid or any kind of power, they're losing tens of millions of dollars, hundreds of millions of dollars. So Arizona has now become a primary market for the economy, for businesses, and that also includes individuals because when they move out here, individuals move out here also.
So one of the things that we talk about here at the Investors Playbook is how my belief is as a real estate agent, you're not going to be able to compete in the luxury market as just a real estate agent. You need to have other skill sets that you're going to bring to the table. I've always talked about being a builder or being an investor and bringing that mindset to you when you want to represent somebody to buy or sell a house in Paradise Valley and Scottsdale. Now, Waseem, you have kind of that two-pronged approach, but just in a little bit different light. You are a lender and also an investor. So being in both chairs, what have you learned? Like what has one helped the other and really elevated you kind of, I guess, in both fields?
So they all have synergies. So when you have multiple skill sets in any field, if you're a builder and an agent, for us, we're private lenders and we're principals. Those synergies help you, first, your ears to the ground at all times, right? You're seeing market conditions, what's happening, how are people evaluating things, what's shifting in the market in real time. And then it's also counter-cyclical on our side. So it kind of when one aspect or one line is slower, another one could be much more, can carry more volume. And then I would say a lot of our borrowers love that we're principals because we understand we can be more forgiving on certain issues. We understand how they're underwriting it. And I think when we were offline, you kind of made a good point, which is absolutely right, is we're a second layer of defense too, right? There's a lot of people, they get inertia and they get overly enthusiastic on certain deals. We can kind of step in and be like, guys, we don't like this. And this is how we're lending and this is the loan to value we're going to lend at, but we don't want you to even do it. And we've seen those too. We've seen. Nico's going to mention it. We'll have lunch and meetings. We'll be pitched all these different things. We'll leave and we're like, hey, we don't want to fund this. We don't want to fund this. We don't think you should do that, but we'll do it at this number. We'll get an email back and like, oh, we dropped those other deals, right? Like they weren't even that excited about it. They just want to know if there's capital out there. So it kind of keeps the guardrails on for everybody. And they love that we're principals in deals, that we understand what they're looking at too, how they should be looking at it.
And I think Waseem makes a really important point. one thing that separates us from a lot of other lenders is we never loan to own, right? Our goal is for our borrowers always to be successful. And so if we lend on a deal that goes to foreclosure, that doesn't bring us any joy. That's not how we underwrite our profits. We always want our money to come in from interest payments, not from foreclosures or taking anything back. And so we have had a couple times where we've gone back to our borrowers and just said, hey, I appreciate that you brought us this loan. We don't think that it's going to work. We think that you're overextended. We don't think that you can make these debt payments. We think that you're over leveraged. And we're not even willing to lend at any number because we don't want to put you in a position where you might ultimately hurt yourself.
Yeah, I think that's something that we can kind of wrap up with, which is everybody that's in this game is probably getting capital from somewhere. I don't know anybody in the game right now that's just using 100% of their own capital at all times. It's just not realistic, especially in luxury. So when you're looking to have a partner that's a private lender or bank or even an investor, I think if they're not bringing some intellectual capital to the table, you may be missing out on worrying about that one extra point in interest or worrying about that one extra point up front and not realizing that the intellectual capital that you guys bring to the table, your experience that you're bringing to the table is possibly a lot more valuable than trying to just save 1% interest and the lender just lends you the money and they don't really help you underwrite the deal at all, or they don't really give you that second line of defense of like, maybe you should consider not doing this deal at all. Not only not with us, but not with anybody. And here's why. Here's what we've seen. Here's what we know. We've seen deals go bad because you didn't have the build cost high enough. You didn't have, you think you're going to build it in 12 months. Everybody else is building in 16 to 18 months. You're going to poke a hole in something and possibly save them.
Well, there was just one other point that I wanted to add. You want me to
I'll clap it back.
All right, clap us back in.
Okay.
Well, I mean, it was when we went off camera, Waseem had made a point that I just wanted to reinforce something he said. Okay. Look, I talked to a lot of beginning investors and even actually some very advanced investors. Waseem, you see these guys every day that come into our office, and their pro formas are just so unrealistic. They have written that growth will never change, rents are always going up, build costs are always staying flat. I mean, assumptions that are not just, it's not even that they don't protect the downside, it's that they're demonstrably false historically. I could tell you definitively that all the things that they're saying are going to happen are not going to happen. If you have underwritten or created a model that relies on growth, relies on the economy always doing well, relies on money always coming in the door in the form of income, you have designed a faulty model. If your model cannot withstand, by design, 2 or 3 bad years, 2 or 3 skinny years, where all of the distributions go to zero, where expenses are higher than you thought they were going to be, where you are going negative for those 3 years, if at the end of that, you have to go out and find new capital, or God forbid, you have to fire sale assets, you have designed a bad model. And so I just say that if there are any younger investors or kind of beginning investors out there that are listening to that, I think that organizational design and model design are really important. And people usually design based on the market conditions when they get into the market. You need to be designing for where the market is going. And in every market cycle, there's at least 2 to 3 bad years where you're not getting the income that you thought you were going to be getting. And so I just offer that in the event that it's helpful.
Yeah, I would also, to that's all really good points Nico made. Another one that we haven't talked about at all yet, but I know we all believe it. Arizona is a very open market. There's a lot of good people out here that will be transparent with you. So find people that you really want to work with, right? There's too many people out there that you shouldn't work with people you don't want to work with. So make sure there are synergies there. There's a cultural fit there. You're enjoying the people you work with. Nico and I have a great time going to the office every day, right? We were just in New York for a week together. That's my best friend. That's the godfather of my son, incredible human being. And we love what we do and we enjoy it, and we enjoy it together. When you find someone, like you're talking about the agent and the builder, get someone on your team if they're the agent, and they should also be good at building, understand building, they understand cost, they can help and guide you. But people that you enjoy having a conversation with, you can work with, and they're open, and there's no ulterior motives, and they really want to work with you. Because if you're doing that, everything else is going to come much more natural. If you're forcing a relationship or you think something is just going to benefit you financially, it's going to be a really painful road.
Yeah, and I would add to that, one thing that Waseem does really well, and I've learned from him in this, build your social circle with people that also can teach you things, right? So when you're going out to dinners, and you're meeting up with the guys, find the people that are doing really well in the space that you want to be in and learn from them always. And so we have these happy hours that really turn into like market roundups. We have 6 guys around the table, and every one of them has something to contribute. And I think that's where I learn, probably 30% of some of my most profitable information is from those dinners, from those drinks, from hanging out at kids' soccer games or whatever it is. Build a life that is constantly reinforcing the knowledge that you think you need to be successful in your chosen field.
I think we're going to end with that. So, Waseem, Nico, thank you very much for coming on this episode of The Investor's Playbook. Remember, you can stream us on all the major platforms. Follow us on TikTok or Instagram. And if you got any questions or you found anything really insightful, shoot us an email. Maybe we'll answer it here on the podcast. Thanks for tuning in. We'll see you next Tuesday.